Hey, Jason here. Today's video we're going to cover Gevo, stock ticker GEVO for Kajona Elston. I'm going to answer, is this a good investment? Is it not a good investment? We're going to do a full stock analysis of this company for Kajona Elston on YouTube, who requested this. Before I get to that though, I need to let you know you can get this series, as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos, make sure to subscribe and hit the notification bell so you're notified every time we release a new video, and release new videos all the time. And if you're looking for more help on becoming a better investor faster, make sure to stick around to the end of the video where I'll tell you how to get some free resources. Okay, again, I apologize for doing this, but I have to do this little disclaimer I'm about to do because every time I forget to do it, people get nasty in the comments. So, I do not own any stock in any company I talk about, and I do not in a long position, and I do not short stock ever. I don't short any stock that I talk negatively about. These are for educational purposes only to help you become a better investor. This is based off my initial preliminary analysis checklist. These are my thoughts only, and again, are for educational purposes only. Why should you listen to me? In the first 9 years of my career, or the last 9 years now, I've produced investment returns on average in the portfolios I manage every year of 23.55%. That puts me right behind Buffett, who produced average annual returns of 24.2% in the first 9 years of his career. I'm not saying that to brag. I'm just saying that to give you reference on that I actually know what I'm talking about a little bit. So, again, I apologize for that disclaimer, but now that that's out of the way, let's get to the analysis of Gevo. Okay, get my screen out of the way. Okay, I know nothing about this stock. Again, this was requested by Kajona E on a different YouTube video. I know nothing about this stock. Never heard of it before. This is my first time looking at it. Not a great thing here. That's a sign, or means it's this is a little bit different. So with forward PE, what I was going to say is this means it's unprofitable now. For the forward PE, this means the company is likely unprofitable now and also expected to remain unprofitable in the future. That's why I was struggling to get my wording together. Again, I've said this in the last couple of videos. I don't care about price sales at all, but that is one sign that the company is massively overvalued right there. Is price of sales of 27. That's a huge number. What does this company do? Renewable chemicals and biofuels company engage in the development and commercialization of alternatives to petroleum-based products based on isobutanol. Hopefully I said that right. Produced from renewable feedstocks. So they are essentially a renewable energy company, specifically focused on biofuels, which are going to become huge in the future. Okay, nothing else of major note here. Oh, so first thing I notice is that they are a $1.72 billion company now, and in the last 12 months they've only done $12 million in revenue. That is crazy, honestly. I don't know what to say about that. I've never seen something like that, except for once, which I'm going to talk about in another future video. Okay. Gross margins negative for most last decade. Not unexpected due to the nature of the renewable energy business. That is pretty common in the industry. Operating income, the percentages look horrific. Negative on hundreds of percent on average over the last decade, but the absolute numbers are not. Negative 25 million in operating profit in the last 12 months. So in other words, they generated $12 million in revenue, and for every dollar in revenue they produced, they lost more than $2 in operating profit. Again, it's not good, but the absolute numbers aren't horrific here. even though the operating margin numbers at its height was negative 674% rounded up, and in the last 12 months it's negative 212%. Those are shocking, but the absolute numbers are not. Net income negative, earnings per share negative, book value per share. Okay, thing to note, I've talked about book value per share in a couple videos. I think Cody, US Steel, and some others, where I give more context into book value. But here is a tip. And before I get to that tip, if you want to learn more specifically about book value, impairments, goodwill, stuff like that, make sure to reference those videos, and you can find those in the links below in the description. Here's a tip, though, on book value that I didn't talk about in that video. If you see something that has an absurdly high book value per share, don't believe it for 1 second. So for those of you on the podcast who can't see this, the book value per share back in 2011 for this company, again, that was negatively profitable, was almost $24,000 per share. The reason I said don't believe this is because A, that's insane. B, if you do see something like this, it can almost guarantee that the book value per share is going to go drastically down over time, either due to impairments, which again I cover at length in the I think it's the Cody, US Steel, and a couple other videos that are below, and also due to share dilution. So in 2017 they had 1 million shares. Now they have 30 million. So they've diluted shareholders by 30 times. That decreases book value per share because the book value per share is spread out over more shares. This also decreases the underlying value per share of the company. And again, likely also some of this loss from almost $24,000 in book value per share in 2011 to 87 cents in book value per share in the trailing 12-month period is likely due to both impairment, share dilution, could be divestitures, stuff like that as well. But that is a tip on book value. If you see something absurdly high, beware. Okay, negative operating cash flow, again, makes sense because of the negative profitability. Negative free cash flow also makes sense. Negative ROICs. I look for anything on operating profit margin and ROICs above positive 10% on a consistent basis. Again, here, same thing here with Gevo. Negative, by the looks of it, about 30 to 40% on average over the last decade. So not good. Free cash flow to sales. I look for anything above 5% on a consistent basis, positive 5%. And this has been negative 100+% over the last decade on average, probably negative 200%-ish range on average. Again, so for every dollar in sales they produce, not only do they lose $2 in operating profit, for every dollar in sales they produce, this company loses $2 in free cash flow. So essentially this company is right now, and again, I know this is a startup company in essentially a relatively new startup industry. So they're going to have to spend capital to essentially build things from scratch, but it's still not a good thing, not sustainable either, which is why you see the huge increase, the 30x increase in share count since, when was that, 2017? Because one of the ways they're staying alive, because obviously their operations are hugely unprofitable, is by issuing more shares. Okay, they got a ton of cash. 52% of their balance sheet is in cash. That's a good thing. Relatively low debt levels, both short-term and long-term debt. That's good. Really low liabilities as a percentage of their balance sheet. Only 12% of their balance sheet is made up of liabilities. That's a good thing. It gives them a huge margin of safety. Frankly, I don't know enough about this business and this company to comment much on the cash conversion cycle. Here, this is a super important number, but typically it's for manufacturers, retailers, stuff like that. I don't know why the cash conversion cycle is reported here, in all honesty. And I don't know, on top of that, if it's important. For example, are they vertically integrated, and that's why it's here, because they have to pay suppliers, they have to get product, they have to process the product themselves, all that. Is that why it's here? Because it takes them a while to get paid from customers? I'm not sure. But typically this number is super important. Again, I reference this in a couple of videos. I think the Archer-Daniels Midland video, I go into pretty good depth on the cash conversion cycle and why that's important, but I don't know enough about how this would affect Gevo to make a big description on it here. Okay. Again, interest coverage ratio, we've gone over this in several videos. Anytime this is negative, it means the company cannot cover its interest payments on its debt with its current earnings or net income. That makes sense, obviously, because its earnings are negative right now. So you want this to be above 1, typically above positive 1, sorry, because that means the company can cover its current interest payments on its debt with its earnings. Typically, the higher the better, because that gives you more margin of safety, because the company is producing more profitability compared to its debt levels. Okay. Let's see here. Nothing much on the kind of basic view there. They have $80.6 million in cash, which is good because they have lower debt levels than that. I know that from looking at the previous thing. Inventories are low, which makes sense. Work in process, so they must be somewhat vertically integrated. Work in process and finished goods, so they must be somewhat vertically integrated, meaning they likely manufacture, refine, whatever the terminology is, their own resources, or let's say they get sources from, let's say garbage dumps, separate their stuff out, like food waste, and they separate that out. Again, I don't know what the biofuel that Gevo refines is, but let's say they refine food waste. Let's say they get food waste in from like a Burger King, for example, and they refine that and they burn it and they make fuel out of that. So that would be this entire process right here. The raw materials, work in process, finished goods, and merchandise. Prepayments and deposits. That's interesting. So they got about 4.6 million in prepayments and deposits from customers. That's future contracts. That's typically good. Most of their balance sheet strength comes from their property, plant, and equipment, which again makes sense because they likely have to refine this material into biofuel. So they have to have expensive equipment, probably some land, all that kind of stuff. Well, debt levels, again, only $13.2 million in current debt. And so they have about $13.8 million in total debt, including short-term and long-term debt. They have more cash than debt. That's a good thing. I explained this in several videos, including one of the last ones, which was, I think, the one on Neo, which, again, you can find that below. I explained what this is and why it's not a good thing. The accumulated deficit in this case and retained earnings, I explained that and why that's not a good thing. This is essentially the total amount of money they've lost over the course of their company being public. Not a good thing to drag on company value, drag on just drag on company value. So essentially this lowers the value of the company by about $480 million over the long term, because over the long term, companies are valued based on the profits and cash flows they produce. Their equity, their book value per share, or their book value right here. Shareholders' equity is also known as book value, is $135 million rounded up, which means they're selling at an enormous price to book. Yep, 12.25. Again, not a huge deal for most modern companies, but still, combine that with the price to sales and the unprofitability here on the forward PE, and I can almost guarantee this company is massively overvalued. Well, that and the revenue only being $12 million, where they have a market cap of $1.72 billion. Okay, PE, again, we can't look at the valuations here because they're all negative, which is useless. So let's look at the chart. Ouch. So this is also, and again, I've talked about this in a past video, this is also why you need to be ultra careful with share dilution and companies that dilute shareholders a lot. This was my guess that this was going to happen, but I didn't say that because I talked about that in another video. Again, I wish I could remember all these videos. At this point, I'm up to 30 or 40, so I'm losing track of which the videos are. They're all linked below this for free. So this is why you need to be careful, especially with smaller companies that issue a ton of shares. In this case, 30X. They went from 1 million shares in 2017, which is down here, to 30 million shares in 2021. When that happens, you decrease the earnings per share, you decrease the value of the company per share, and typically, unless they're in some kind of bubble industry, which frankly I expected this one to be, it destroys value in the company. And in this case, since 2016, late 2016, mid 2016-ish, so was that end of August, it's lost about 94.4% of the value in its shares, all the way down from a high of $323 per share, $323.20 per share during intraday trading on August 31st, 2016, to $10.71 per share. This is what happens when you dilute shareholders a lot. It's not a good thing. Yes, I understand, especially in startup industries and startup companies, this is sometimes necessary to keep the company alive, especially when there's unprofitability and stuff like that, which Gevo is dealing with. But this is what it does over the long term if you continue to dilute shareholders. And again, this isn't just small dilution. This is 30x dilution, not 30%, 30x. When you do that, it destroys the value of the company because it lowers the value per share. And over the long term, companies are valued based on the profits and cash flows they produce. At the basic level, that affects the entire company, of course, but at the basic level, that affects the share price, which affects the entire value of the company. So this, again, not good. Doesn't look bad if you do only a 3-year view. Looks really good if you do the 3-year view, especially from, let's say, 2020 lows at 46 cents per share to if you bought on July 3rd, 2020 at 46 cents a share to today at $10.71 per share, you made a ton of money. Congratulations. But having said all that I've said about the company, let's bring this back over here and get me back since you're not just staring at the screen. I would not recommend investing in Gevo today. It's massively overvalued. It's massively unprofitable. It's diluted shareholders by an enormous amount and likely will continue to have to do so because it's unprofitable. And yes, if you invested from July to today, you made a ton of money. If and when, and again, this is likely, the company dilutes shareholders again, it's going to lower the value per share of the company, which is going to lower the overall value of the company, which is going to drop the share price. Again, it probably won't be as drastic as the 95 almost % drop since 2016. But over time, if the company has to continue diluting shareholders just to stay alive, which is essentially what Gevo is doing, it will destroy the value of the company. Having said that, Could this be a long-term potential good investment if you already own shares? It could be. Biofuel industry, I know it's 100% it's coming. It's going to happen. It's a lot of the world is going to go to that at some point. Biofuels, solar, wind, all that stuff. It's coming. It's already here in a lot of the world. Specifically where I live in Florida, solar is huge here. But having said that, this is still a highly risky arena to invest in because it's still relatively new. The company is still massively unprofitable. And because of that, I would still be wary about holding it long term. Again, relating it back to the dilution. If they were profitable, that'd be a different story. Because they're not profitable and they really never have been, except for about 10 years ago for a couple of years, the dilution is, again, that's likely. When that happens, that will destroy value in the shares, which will lower the shares. So even if you're holding long term, I would be ultra careful because, again, of the share dilution and the unprofitability. Other than that, those are my thoughts on the company. Again, it's coming, but the way I look at stocks is different from most people. I value the stock based on what it's currently doing and its past, or what it's currently doing. I also factor in past stuff into my analysis, although it doesn't matter as much as current stuff. What I don't really factor into my analysis is future stuff. I look at that as icing on the cake. If it's a good thing, great to have, adds value to the company. If it happens, again, if I don't invest on ifs though, I invest on based on what the company's doing now, today. So if it's a bad thing, then I discard the company, or I might discard the company if it's a major red flag type of thing. If it's a future thing, like an industry disruption, whatever you want to call them. So I hope that helps. I hope that answers your questions. If you have any more questions, if I didn't explain something well enough, let me know in the comments below. If you want me to look at a stock for you, let me know in the comments below. I think this is the 4th or 5th company I've looked at for Cajona. I've also looked at stocks for other people. I've got more stocks on the list to look at for other people. If you want me to look at a stock for you, let me know in the comments below. The only stocks I'll look at stocks worldwide. The only stocks I will not look at are banks because I don't evaluate them, and insurance companies because you actually have to dig into the annual reports to fully evaluate them. So if you're watching on YouTube, make sure to like, love, share, subscribe. And if you subscribe, make sure to hit the notification bell so you're notified every time we release a new video, and release new videos all the time. If you're listening on the podcast, we really appreciate all that stuff on YouTube and the podcast. Like, love, share, subscribe, comment as well. We'd also appreciate a review on the podcast because the more reviews, views, and listens we get on our content, the more people we can help. If you're looking for more help to become a better investor faster, to better and faster evaluate companies so you can discard the crap companies better or faster, and spend more time evaluating good companies, make sure to check out our free gifts below. You can get 3 things below for free. Our 5 free gifts, which includes my full preliminary analysis checklist, which I just went over the visual part. It includes the full doc for you. You can also get a free PDF copy of my book, How to Value Invest, which shows you valuation techniques, goes over terminology, goes over my reasoning, my mistakes that I've made, stuff like that. So you can learn from it. You can also get my free guide, 7 tips to picking great stocks and 3 times you must sell. You can get all 3 of those for free at the links below. All 3 will help you become a better investor faster. If you're looking for more specific help from me, make sure to also check out information below on our masterclass. And until next time, I think that's it. Until next time, have a great day. Talk soon.